the good, the bad, and the ugly.
There's an often used expression in our industry that markets go down the elevator and up the stairs. However, this year, one of the sharpest and swiftest market declines in history has been followed by one of the swiftest and sharpest climbs. This phenomenon has puzzled the investment community and investors alike.
In continuing with our video series, we explore where we are today and what paths may unfold before us. In our view, we expect the recovery to be a long and slow process, with 3 different scenarios potentially unfolding. To build just enough spaghetti western drama, we have dubbed the scenarios the good, the bad, and the ugly. The good.
The good scenario sees a rapid economic recovery come to pass if the massive worldwide scientific race to develop a vaccine or other medical treatments produces early and scalable results, therefore reducing the need for social distancing faster than expected. More than 100 vaccines are currently in development across the world, with 36 already in human trials. It's unknown if any of these will be successful treatments or what degree of protection these vaccines will provide. At this stage, even for the experts, it is virtually impossible to make confident predictions on when effective medical cures will be available. The bad.
The bad economic scenario of much slower recovery, even a double-dip recession, would most likely result from strong and widespread second waves of COVID-19 infections that lead to government-mandated lockdowns and further interruption of economic activity. History and common sense suggest that second pandemic waves are the norm rather than the exception. Parts of Asia and many regions in Europe and the United States have already seen a re-acceleration of infections as mobility and activity have picked up. How widespread and strong such second waves will be remains a guessing game. The ugly.
Needless to say, a double dip in economic activity caused by a significant second wave could easily turn a bad scenario into an ugly one. Cascading bankruptcies of many small and medium-sized companies that have been kept afloat with emergency government funding would become more likely, with temporary layoffs turning into permanent job losses. While the health situation is currently the main swing factor for the economic outlook, there are, of course, many factors that pose risk to the baseline scenario. These include trade tensions between the US and China, continued civil unrest in the US, and the closely watched run-up to the US elections in November. Any of these issues could easily reduce business confidence, tighten financial conditions, and derail an already fragile economic recovery.
An assessment of the current economic backdrop and financial market conditions leads us to believe that the significant rally that we have witnessed has been built on optimism and has overlooked many potential negatives. This market rise has been driven largely by central bank injections of money and by fiscal stimulus with the intent of providing a bridge to recovery. It appears that markets are assuming that the path to recovery will be swift and free of highly negative consequences. As we've said before, we don't know for certain what path the economy or financial markets will take, only that we will need to be forward-looking rather than investing by looking in the rearview mirror.
We remain cautious and are not inclined to take on unnecessary portfolio risk to try and achieve a potentially higher rate of return. As always, please feel free to reach out and contact us with any questions or concerns you may have. Take care and stay safe.